Morning, afternoon. Thanks for being here. We've seen countries like Brazil allow payments not just from digital wallets or payment apps, but as was discussed a couple times this morning, also directly to and from bank accounts as well as instantly between digital wallets from different non-bank providers. As you know, stablecoins, the lower fees, more payment provider competition, wider accessibility. And because stablecoins reduce the cost of the transactions to nearly zero, I think there's a lot of members that are trying to wrap their minds around this. And you know, they can, it just frees up retail businesses, right, with the frictionless, low-cost alternatives. So, Mr. Collison, can you just discuss, I know you've touched on this already, but can you discuss how providing kind of the regulatory clarity through the Stable Act could increase or will increase consumer adoption?
Absolutely. So I think in financial services, ambiguity is the greatest inhibitor to adoption. You know, things that are clearly permitted or clearly proscribed, you know, that's clear. And I think we've seen in stablecoins is a lot of enthusiasm, a lot of excitement, but also significant hesitation because you know, well, it's not clear how the ecosystem is going to unfold within the U.S. I think the single most the single best way to ensure that US dollar stablecoins are broadly adopted around the world is for Congress to provide that regulatory clarity.
Right. In a regulatory framework will also give businesses more incentive to use the stablecoins for operational transactions, right? Wouldn't you agree? Some stablecoin, I know that some of the issuers are establishing kind of strategic partnerships, I guess you'd call them, and trying to link up with traditional payment companies. So, Mr. Cascarilla, can you discuss some of Paxos partnerships and explain how these kinds of relationships that you guys have been able to develop helps with the integrations and the incentivizing the adoption of all this technology, right?
Well, I think one of the interesting components about a stablecoin is that the interest is being kept by the issuer, and as a general matter. In our case, we are setting up partnerships where the interest is being returned to the distributor, whoever might be controlling the end user as a payment company or otherwise.
Right.
And that's an opportunity then to eventually maybe pass that on further through rewards to the end user. So you create an ability not just to democratize access to dollars, which is I think what stablecoins do, but you could even start democratizing access to the risk-free rate. And that's a really important way of changing how the financial system works and how individuals are able to access it.
So let me go back, Mr. Collison. So there's been some confusion as to the difference between U.S. CBDC, a stablecoin, and the FedNow system, right? I mean, it's I hate to pick on the Financial Services Committee, but I think it'd be hard pressed to get somebody to come up with a definition for all three. What would you describe the differences between the three and the issues that they're seeking to resolve in the U.S. payment system? How do you view those three topics or headings, I guess?
I think FedNow provides a valuable service for making interbank transfers within the U.S. more streamlined, and that's very helpful. It doesn't provide the same degree of global access that stablecoins or, in principle, CBDCs could. With respect to stablecoins versus CBDCs, I think that the US gets basically all of the benefits of a notional CBDC without some of the attendant downsides that have been discussed here today. And so my view is that there's very little downside and tremendous degree of benefit to formalizing stablecoins along the lines of what's proposed. And beyond that, I don't really see how a CBDC would help. And to again some of the points made, I think it could easily inadvertently inhibit innovation.
Thank you very much. Thank you all, and I yield back, Chairman.